what I want to focus on is giving you an idea of what things are going to look like and what you're going to be faced with for financial planning purposes as you graduate, start earning an income as a resident, depending on your specialty and your career track, potentially fellowship as well. You're going to be probably in your late 20s, early 30s by the time you really start making some decent income. My older brother, Brian, he's about 6 years older than me. He's an anesthesiologist, does cardiothoracic cases out in California now. And I got started in the industry right when I graduated Westchester University, excuse me, in a degree in finance back in 2009. And my boss at the time, he said that, Dave, you got to really build your own book of business. You have to find clients, you got to sell, your story and share with people what you do. So I worked with this company called Legacy, which was a independent fee-based financial planning firm. We all had different teams, and I learned a lot through, my peers and, superior partners, if you will. And when I spoke to my brother when he graduated, actually PCOM, this is probably in the mid 2000s or late 2000s when he graduated, and he was finishing up his residency at Temple. He's like, Dave, I need help. I'm getting married. I have $250,000 of federal loans I got to pay off. I'll be making a good salary, once he became an attending. But he just really never got any type of exposure to financial education. So that really sparked an idea for me. And I said, well, Brian, I'd be happy to help you out, of course. And, helped him with a budget, helped him with cash flow, just educating him on different types of accounts that are out there, putting a structure around his student loan repayment and different insurances and things like that I helped him put in place. And I said, Brian, you're probably not the only one, that's kind of having these questions or needs guidance from a financial perspective. And he says, well, if you say there's free alcohol, I know other people are going to want to join. So I did a happy hour presentation PowerPoint at Kildare's in Manayunk, and he brought a bunch of his peers and other residents. And I started building a lot of clients that way. So fast forward about 15 years, I would say about 90% of my book of business is made up of physician and healthcare workers, physician's assistants, et cetera. And I've just really learned a lot and got a really good idea of what's important. What are some things that you guys are faced with and how best to tackle them with financial strategies, tax guidance, et cetera. So I hope this is educational and helpful. I'm a big proponent of motivating people with knowledge and really getting a good sense of planning, for the future. And as Des was mentioning, just kind of getting situated here. I had to pick up my son at daycare and have him in the other room. So I hope there's no interruptions. And my wife, she's coming back. She's actually a CRNA over at CHOP, but she had to work in the city today. So she'll be back here around 6:20. And at that time, I just want to take a quick break. I'll leave you guys with some things to work on. I just need to get situated downstairs in the office. But we'll get started here. Gave you a little bit of background about myself. I'll leave this picture up in the background, but High Point Financial was established about 6.5 years ago. When I mentioned I worked at Legacy with a team, we decided to branch off from Legacy and start our own firm. Became one of the partners there. There's 3 other partners that I work with. We have a administrative assistant that helps out with client servicing and account opening, et cetera. But the 5 of us work with Commonwealth, which is our broker dealer. They're the largest independent broker dealer. And essentially a broker dealer just gives us access to investments and insurance products. And it's all regulated by the SEC and FINRA. And we basically clear our business through them. It's almost like a Fidelity type of trading platform and service model that we go through. But we're independent. We don't have any of our own proprietary products. Everyone's really unique. And, we really focus on financial planning for personal individuals and business owners. So I wanted to just share this picture with you just to kind of get you motivated, have you thinking about the future. And if you look back, 4 or 5 years ago, you might have been in college or, maybe high school if you're just starting out in medical school, but, things really change over time. And I hope this presentation here and the thoughts that I'll share with you are really going to give you an idea of what your future could look like. And you're in the best spot, because you have some really good, unique abilities with your student loans that you can, get started on. right out of the gate, especially if you're going for public service loan forgiveness. Being young and healthy, you can get really inexpensive insurances just to lay down the foundation. And even just your first couple paychecks, when they start coming your way, you could really create a really good budget and plan ahead for what you want to focus on, whether that be really trying to save and maximize retirement accounts, or really build up a cash cushion for a potential down payment on a house. Whatever it looks like. Everyone, again, is very different, and things are going to change. But I think it's really important for you to write down some goals, have a really good idea of what's important to you and how best to manage your money effectively, so that as time goes on, your picture is going to change and become really what you desire, over time. And that's the whole reason why I got involved in finance. That's the degree I graduated with at Westchester. And that was something I really focused on because I love the idea of how money gives you time, and it gives you the ability of freedom. When you go to retire, you have a really, large nest egg to live off of and do the things that you want to do, and hopefully not have to work forever. So I just want to give a brief introduction to the case study. It's kind of broken down in two parts, the presentation, and the tail end of it just kind of goes through like an overall model and idea of different types of advisors and professionals out there to help you build your financial plan. So I just want to give an introduction. Then why don't we just take a quick, like 2-minute break, if that. And I do want to leave you guys something to work with.
Sounds good.
So introduction to the case study here. We have a graduating medical school student. Whether you're about to graduate and you have a residency program lined up, and or if you got a couple more years to go, I think it's really important for you to think about, hey, you're going to graduate. You probably have an idea of what kind of student loan debt that you've acquired over the time. If you're going to go for the public service loan forgiveness route, there's all sorts of different types of income-based repayments that are really helpful to calculate. And I know there's an exit program, which is really fantastic and valuable at PCOM, where you could basically share with, the student loan department, and give them information on your student loans, and they could help you set up your income-based repayments, so you have an idea of what that expenditure is going to be, and then you could build the rest of your budget around that. And the main things are probably rent, unless you have a mortgage and you're buying a home, personal living expenses, going out, groceries, gas, etc. And then, some of the discretionary things like, gym memberships, or, going out to dinner and the movies, and, traveling, or gifts, those are things to really try to break down. What are the needs, the necessities just to live, versus the wants, the desires. So if you guys can, spend a couple moments maybe writing down some of your main goals, and try to just not necessarily, quantify it, but just, some of the most important things to you once you start earning a paycheck. Typically I see residents when they first start out are making about 65,000 per year. And, after taxes and different types of insurance that come out of that paycheck, you're probably going to net around $2,000, per paycheck, because Uncle Sam and the IRS obviously take their haircut out of there. So, giving yourself an idea of, if I'm bringing in about $5,000 a month, let's take out, to be really conservative, 20% for all the related deductions and taxes, then you're left with about $4,000 per month. So if you're looking at apartments, and, or if you're looking to buy a mortgage, or get a house and get a mortgage, then, that's going to eat into your budget, and then you're left with the remainder. So think about your needs that you have, some things that are known as far as expenses go, and then things that are important to you, whether it be, again, discretionary spending or savings. And those are some things I want to cover for you. And at the end of the day, again, everybody's different. And I do want to educate you on some things to avoid, and some things that I think you can really take advantage of, especially while you're young. And just lastly, purpose of the case study: provide a roadmap for this fictional character, Sarah, as she goes through her financial journey, kind of transitioning, graduating from medical school student to a resident in whatever program she's entering. So why don't I just take a quick pause right there, and then I'll be back in just a few moments. I just need to get set up downstairs, if that's okay.
Yep, sounds good.
Okay. Yeah, if everyone can just kind of maybe jot down some thoughts. It doesn't have to be in any particular order, but I think it'd be a good kind of brainstorming session while I take a quick pause and figure out what's important to you. All right, I'm back. Thank you for your patience there. And you guys could hear me okay?
Yep.
Okay, great. So you guys don't have to share, what you've written down. Some things, if I was in your shoes, would be, just crafting a budget, understanding different financial tools that are important for me. Obviously, if you have student loans that are outstanding, figure out what kind of repayment plan makes the most sense for you. Depending on your specialty, you can get a sense. You can probably search online what the average income is going to be. I work with a lot of anesthesiologists, surgeons, emergency medicine folk, and basically, depending on the specialty, it's really going to drive how much income you're going to derive, once you finish up residency. So, taking it a little step further, these are all different tranches that you're going to go through in your career. So, finishing up medical school, borrowing money from student loans to, fulfill your lifestyle and tuition needs, and then becoming a resident, and then kind of turning the faucet the other way, where you're going to start collecting an income, obviously paying taxes, living in your situation that you have, trying to save money as best you can, getting important things laid down in the foundation of your financial plan. And then once you graduate, or if you go to a fellowship, it's kind of the same thing as far as residency is concerned from a financial perspective. But then once you graduate to an attending, your income's going to multiply 4-6 times what it was, if not more, as a resident. There's a really good book and resource called Real Life Planning for the Young Physician. I've read it multiple times. It's all kind of rattled, and all the pages are kind of turned all sorts of different ways. But I spent a lot of time reading that. I forget the author off the top of my head, but it lays a really good educational format for those that are in residency, what to focus on, and then how to prepare yourself as an attending. So kind of getting a sense of, what that looks like and preparing for that next tranche is just going to really help you, stay organized and focus on the things that are important for you. So for Sarah here, she's got student loans, she's got some savings, obviously she's got expenses, we all do. That's more or less what the quantitative information is for her. And for financial planning purposes, I like to break it down quantitative, understand all the numbers, the finances, the dollars and cents, and then getting a good idea as far as what goals are like. So I broke it down: short, medium, long-term goals, just giving you a couple examples. Short term, paying off any form of debt, establishing an emergency reserve. Typically, a lot of clients that I start working with pay off their credit cards every month, which is great. Some have existing balances, which they just kind of, got behind, the eight ball with, and weren't able to pay off some credit card debt. And that really affects you from a couple perspectives. One, credit card debt doesn't help your credit score. So your credit score is going to drive your loan or financing ability. If you go, buy a house or go buy a car and you need to finance money, so basically borrow. And if you don't have a great credit score, then your interest rate is going to be higher because the lender sees you as being, a little less solvent and having a little bit more of a difficulty paying off. So they see you at risk and they charge more interest for that. So try to make sure if you get credit cards, I'm sure most of you have it, if not all of you, we really need it for online purchases or traveling, to try to pay them off monthly. All my credit cards, ongoing expenses, so like utilities, cell phone bill, internet cable, everything that I have to pay for, gas, I put on my credit card, and then I get some reward points and, pay that off every month. And then looking at some of the student loan debt or auto loan debt, just try your best to get the best type of rate that's out there, and also something that's affordable, in your budget. Medium term, saving for a house or a down payment, vacation home. And then long term, typically people want to retire comfortably and make sure they have enough saved up. And this I could send if anyone's interested. We have a couple different formats of it, but it's a really good tool to basically get all your information from that quantitative perspective. So if you look top left, I like to call this the four pillars. So understanding income, which is not included here, but obviously you'll have a sense of what that looks like. So income and expenses, assets and liabilities. Those four pillars are going to build out that quantitative plan. So you can list out all the different types of assets, things that you own in your own ownership, which have value associated to them. And there's all sorts of different types of accounts that you can see there. Liabilities, these are things that you owe back to somebody, and they typically have a term, meaning some type of duration, maybe a 5, 10, 15. Mortgages, are typically about a 30-year, mortgage. So that would be a 30-year time frame. And then after that, it's gone. So liabilities have an end date. They have interest, so that basically when you're borrowing money, it's time value to the lender, and they want to get some type of earnings back on the money that they lent you. And then expenses, that's just things that you would pay, whether it be your rent or your mortgage, different types of personal expenses. You could see everything that's listed here. And I have a fillable PDF and an Excel, but this would be a really good tool to, jot down some information, get a sense. And some people, when I share this to them, they turn it back around like, oh my God, I don't realize how much money I'm spending on XYZ, or whatever it is. So it can be eye opening, but I think this is the best way, even though this is also probably the most work clients have to do, to kind of reflect back and get a sense of where, their money's going. This is one of the reports in our planning software. It's called eMoney. I just wanted to share this because when clients come back to me, or if you end up working, with a financial planner, their job is to help not only advise you and give you guidance, but also get you organized. As time goes on, things are going to get more and more complicated. My boss, when I started at Legacy, he would always hammer that to me. He's like, "Hey, as time goes on, you're going to get married or have kids or start a family, buy a house." And he was 100% right. Things get more and more complicated because you just don't have the time to really focus on these things. So creating a good habit and getting organized early, and then just add or build to what you have put down is just going to help you stay on track at the end of the day. So this is one of the reports called a net worth statement, and it just breaks down assets that you see up here. So I have James and Sarah, just fictional individuals. They're married. They have a joint checking account, which is basically like, a checking account at a bank that both have access to, so they can add money to it. They could take money out. So I think if you're getting married or getting serious with someone and you want to start, working with your finances together, having a joint type of account is helpful. Each have their own types of savings account with their individual banks. They each have retirement plans, set up. You can see here for Sarah, she's got the Hospital University of Pennsylvania 403B plan. And I get this question a lot. They're like, well, what's the difference between a 403B and a 401k? And the only real difference is it's just the IRS tax code. So anything that's a 403B is a group sponsored or employer sponsored retirement plan for a nonprofit organization. So a lot of hospitals, schools, charities, they have 403B plans, and then for-profit companies are 401ks. So if you go into private practice, or if you're working for a for-profit, institution, it's just a 401k, but they work the same way. You basically can set aside a portion of your income to put into a retirement plan. You can invest it into different mutual fund options, and that money, hopefully over time will grow, and then you could live off of that in retirement. So then James here, he's got a Roth account. It's an IRA, which just stands for an individual retirement account. I'll talk a little bit about the differences between a Roth and a traditional IRA. They have a home, which has a value to it. Typically, real estate appreciates over time. And then you could see on the liability side, some outstanding student loans and a mortgage that they have on that property. So they're in their, he's in his fourth year, and he's going into a fellowship program for, I think, spine surgery, and she's a nurse. So the two of them are, making, decent money. Things are going to change once he graduates out of his fellowship, and they just really wanted to get organized and get things in line. So talking a little bit about budgeting and debt management, for Sarah here, she did her budget, she got all her expenses lined up, she understands what her income is, and that really creates what's called cash flow. So money coming in, that's income, and then expenses, money going out, that net difference, whether positive or negative, calculates cash flow. And cash flow is really the bloodline to a financial plan, because once you have your emergency reserve set up and you got your protection in place, you got your student loan or debt reduction strategy in place, then understanding what the potential excess is going to help you direct that money, whether it be plow it more towards your student loans or other, outstanding debts that you have, or saving it. And building a good habit around where best to direct that is going to make that picture, that journey, a lot easier to achieve over time. She's got strategies for her student loans, and then she obviously wants to avoid high interest debt and building good credit. Some good resources here too that you can lean on. There's a student loan repayment plan that you can go through and just add some information about yourself, your finances, and then actually can give you different types of repayment plans, and what the projected payoff amount is if you're in public service loan forgiveness. The only downside is when you enter information, especially as a resident, if you're making, 60, 65,000 a year, it assumes that for the remainder of that 120 monthly payments, that 10-year repayment plan. So when I work with clients that are transitioning, I revisit that site, add in their new income, if they're married or not, add that information in, and then see what makes sense going forward. The other thing is that's interesting is there's an income driven plan called Repay, and now it's called the Save program, and there's another one called the Pay as you earn, the Pay. And what's important about those two is if you're married and you want to see if it makes sense to file taxes joint or separately, you would want to enter that information in, because the pay plan, if you file taxes separately and you're married, then it'll only take your income to start paying towards your student loans. The save plan or the repay plan basically takes your household gross income regardless of how you file taxes. So if your spouse is making $200,000-300,000 a year, then a portion of that income for your spouse is going to have to go towards your student loans. So it's a good analysis or evaluation to see, does it make sense filing joint and seeing the tax benefits versus separately, and then seeing what the estimated repayment's going to be if the income's included or not. All sorts of repayment plan options and information on Mohila. And if you decide to go into like a private practice, post residency or fellowship, and that public service loan forgiveness program isn't going to work for you, then I typically suggest credible.com. It's a meta site for different types of lenders that can take your existing student loans and refinance it. So it's important to understand what's existing, what your interest rates are, and if you feel like maybe it makes sense to try to find a cheaper interest rate, I think Credible is a really good way to get started. So just from a high level, this cash flow management strategy is called the 50-30-20 rule. So basically, if you look at what comes in the door for your cash flow, I would say 50% of what you make goes towards your fixed expenses. So anything that you have to spend money on for your lifestyle, your needs, your rent, your mortgage, food, etc., 50% can go there. 30% can go to dining out, the movies, vacation, travel, gifts, etc. And then 20%, if you can set that aside for long-term savings or building up your cash reserves, then I think that would be a really good general rule of thumb to get started with. So if you could figure out, roughly how much you're going to be bringing in on a monthly basis, then just times, it by 0.5 and by 0.3 and by 0.2, and it'll spit out numbers for you. And that might be a good way to get a sense of, where to direct your money. So for Sarah here, as she's starting as a resident, you get different types of employee benefits. Typically, what I help people with when I review these benefit packages is the retirement plan, get a sense of what type of 403B they're working with, looking at the different investment options. They're typically all mutual funds, which are a portfolio of different types of stocks or bonds or both. That would be something that you can even just do some research or homework online to see what's a good fit for you. Typically, when you're young and you have a long horizon for retirement, I typically suggest being aggressive And over the years, these mutual fund companies made it easy for those to basically say, I'm going to retire in, 30 years or 40 years. So at that point, we're looking at like 2055 or 2065. And they have these retirement date funds that are designed to basically be aggressive while you're young. So mainly having stock exposure and not a lot of bond exposure, and then becoming more conservative as time comes on. So for a 2055 fund, it's going to be very aggressive. But then let's say in 2040, the mixture or the makeup of the allocation is going to get more conservative because you want to have less volatility in your investments when you get close to retirement, because you're going to need to rely on that money soon. So they incorporate more bonds, which are a little bit more predictable, less volatile than stocks generally, and they also give what's called income through interest payments that come out. So it starts creating almost like a pension within the fund. It starts giving you interest daily. Bonds can also appreciate or depreciate, but again, not as much historically as stocks would. So that's a good way to get started. You could also build your own custom portfolio if you have an interest in designing your investment differently than a target date fund. But I think they're really good ways to get started. So she looks at that. She looks at the different types of healthcare plans. There's HMOs and PPOs. Again, if you don't have a whole lot of medical issues and you're, relatively healthy, then I would say find some type of high deductible plan, because that what that does is it makes your premiums that you pay for very inexpensive, but the deductible or the payment, if you do go for surgery or some expensive hospital bill, you're going to have to come up with more money out of pocket versus a less expensive or a more expensive type of plan. With a high deductible plan, they also incorporate what's called an HSA, and an HSA is a health savings account. This type of account, you could basically put a portion of your income into it. I forget what the max is off the top of my head. It's probably $4,000 or $5,000 a year. But anything that you put into an HSA is a deduction off of your income, so there's a tax benefit, and then that money can be used for prescriptions or down or co-payments, hospital visits, any type of medical type of bill or expense. You can use that account for. So typically I encourage people to look into those because you get a tax benefit, you save some money there, and assuming you're not going to be too risky with your lifestyle, knock on wood, you're not going to have any major health health events coming up. The other thing I want to encourage you to look at too, to see if there's a match. So sometimes there's match programs within a 403b or 401k. Typically, this isn't common for residents. When you start working as a resident, you have access or eligibility to a 403b, but they don't really give you a match. And what that means is the employer would give you a portion of what you're putting into, or the full amount up to a certain limit, into your retirement plan. So let's say you deferred or put away 6% of your salary every paycheck. A company may match that, give you 3% as an example into a matching program. So I always encourage people to maximize the match as a minimum. So that way you're getting, free dollars, and then that gets invested for your own retirement. If there's really no match program, then I would encourage people, if they want to save for retirement, to do what's called a Roth. So if the 403b allows a Roth option, then take advantage of that. If not, I would say open up an individual retirement account that would be a Roth account. And I'll get into the differences of those in a little bit. The last piece here, this is probably more as an attending, or if you're in your final year of residency, some people have the ability to moonlight and generate some extra income. And if that's the case for you, then think about where you want to direct that money. All right. So looking at savings and investing here, I always recommend at a minimum 3 months of your expenses should be set aside in cash. So if you're spending, $3,000 a month, $9,000 to $10,000 just in your savings would be a really good target. The reason being is because you'd hate to go backwards. God forbid something happens to your car or your house, or some unexpensive significant expense comes your way. You don't want to, rely on credit card debt or other things like that. The other reason 3-month minimum is key is because a lot of residents will get disability insurance, like an individual disability insurance policy that protects your income. And with disability policies, generally they have what's called a waiting or elimination period. And what that basically means is you just have to wait a certain amount of time in order to receive that monthly income benefit. So most policies that I structure for my clients is a 90-day or 3-month waiting period. So that means that if God forbid something happens and they can't work and 3 months go by, they can rely on their cash needs to support their lifestyle. And then the disability insurance policy kicks in within 90 days or 3 months. Beyond the savings and cash, she's starting to look into investing. You probably heard the term diversification before. That just basically means don't put all your eggs in one basket, spread it out, because that's going to reduce market risk and it really helps you achieve stronger returns over time. So, for an example, if you owned a stock that was $100 in value, and if the market lost 50%, your value now is $50. Now, if your stock rebounded and gained 50%, that's only $75. So it's important to protect on the downside because there's more damage done and it takes your money harder to work to get back to where it was. So diversification is important. Risk tolerance, that just means how much willingness you have for potential returns. So typically, the longer the time frame, the more aggressive you can be. If you have a shorter time frame to use that money, a more conservative approach makes sense. So understanding, how risky or conservative you want to be, and then investment options, whether that's mutual funds, stocks, bonds, ETFs, which stand for exchange traded funds. I think it'd be important for you to understand, if you're saving money and investing it, what's it invested in? How's it being managed? Is there cost to it, etc. So yeah, retirement planning. She's setting up her contributions. This is that 403b type of plan or 401k. And then for Sarah here, she's taken advantage of the Roth IRA. The benefits of a Roth is that when you put money into a Roth account, so let's say you get your paycheck, you paid your taxes and other expenses that come out of it, you can put money that's already been taxed into a Roth account and invest it. That money grows over time and then it becomes available at 59 and a half. That's the retirement age for retirement accounts that you could take money out without penalty. And then that's all tax free. So if you put, $5,000 into a Roth and it doubles and doubles and doubles over, 30, 40 years, it could be a $40,000, $50,000 account balance. So maybe you only paid, $1,000 in taxes and you put the 5,000 in, but now you have $50,000 or so that is non-taxable. So being in a low tax bracket, being young, and establishing a Roth account is in my opinion the strongest type of wealth accumulation vehicle that you can do. If she was to do a traditional IRA or a 401k or 403b, that's a non-Roth, these are called pre-tax contributions. A pre-tax contribution means that $5,000 in that same example goes into a retirement account that's an IRA or a pre-tax account, and you get a tax deduction. So if you're making $60,000 a year and you put 5,000 into this IRA or a 403b that's pre-tax, then you're only paying taxes on 55,000 because 5,000 that was contributed is sheltered from taxes. That money goes into the account. It can be invested, the same way as a Roth account. And then when you go to retire, that balance, let's say again it's $50,000, becomes taxable as ordinary income. So I always say, would you rather pay taxes on the seed or would you rather pay taxes on the harvest? And it's likely you're going to be in a higher tax bracket when you go to retire than when you are as a resident. So trying to maximize the Roth and take that full advantage every year is really going to help you out in retirement. Here's just a high level picture of just, I call it the bucket approach, just to give you an idea of different types of cash, reserves, taxable, and retirement. So they all have different types of tax benefits to them and different needs. So when I talk about just the fundamental, or the foundation planning, you want to establish cash reserves, and you could just do that with your bank. If you have your savings account, with a decent chunk of money, and you have that set aside for emergencies, I typically suggest to my clients to put that into a high yield savings account. Personally, I use Ally Bank. I know Capital One 360 has a generous interest rate as well, but typically most banks, Bank of America, TD, PNC, they give you pennies on the thousands in interest. I might get 0.01% on my PNC account, but I use that for, collecting my income and then, expenses and bills, etc. But the bulk of our savings here, my wife and I, we put into a joint Ally account. Ally's FDIC insured, just like a normal bank is, but it's just an online institution. And I think it's like 4.3 or 4.5% interest that we get on that money that we're just sitting on. So if you have some money sitting on the sidelines, try to get the best bang for your buck without taking on extra risk. So that would be kind of a cash reserve or checking and savings. The taxable type of account is a non-retirement account. So some of you probably heard of Robinhood or E-Trade. Basically, those types of institutions have taxable accounts. They might even have retirement accounts too, but you can buy investments or different types of mutual funds, and anything that gets generated as far as interest or dividends, or if you sell a position or a holding that has a gain, it's going to be taxable. So you get the benefit of flexibility, not being subject to retirement. You could use it whenever you want, but you're just going to pay taxes on it as it accumulates, or you take distributions off the growth. So that would be a bucket to fill after you maximize retirement, unless you have a goal to, save for a vacation home or, some other type of heavy expense in a 5+ year type of time frame. Because with retirement money, again, it's subject to 59 and a half. The reason why I encourage the cash reserves to be appropriate and retirement to be maxed out is because retirement is something where you get tax benefits from as you invest that money. And it's something that you're going to really need to rely on once you stop working. So switching gears here, kind of the savings and the investment side, that's kind of the offensive game plan, if you will, to accumulate your wealth and assets. This is more of the defensive side, looking at insurance and risk management. So here, this kind of breaks down into a couple categories, at least from my perspective, which would be life insurance and disability insurance. Those are products that we have access to, and being independent, we shop the marketplace with all sorts of different carriers to see what's the most competitive cost and benefits to you. But with your employer, you're going to get health insurance. Typically, I don't see residents getting any type of group long-term care or long-term disability plan, but it'd be worthwhile to look into there. Sometimes they give you a form of life insurance, $50,000 a year or one-time salary. So understanding what those benefits are is going to help you supplement through the individual side. So for younger residents, or at least before you graduate, I always encourage you to explore disability insurance, because your greatest asset is your mind, your hands, your ability to work. If you're making $200,000-$300,000 a year, within 10 years, that's $2 to $3 million. It's pretty substantial. And also, if you have student loans or heavy expenses to put your money towards, then it's important to protect that. So disability insurance is a tax-free benefit. If you became unable or sick to work, then within that elimination period or waiting period, you start collecting a monthly benefit, and it's non-taxable. So if you have a disability policy that pays you $5,000 a month and you're injured, you're going to get $5,000 per month until you're healthy enough to return back to work, and that money's non-taxable. So definitely consider disability insurance, and just arm yourself with some education around it to see what's appropriate. On the life insurance side, I really don't push this too much unless you're married and have a family, or if you have some debt obligations that are shared with family members, just to protect that outstanding balance that you have on your end to pay for the other individual that might be liable. So if you have a mortgage and your family relies on your income, then it's important to figure out how much life insurance do I really need and what type of policy I should go with, because there's all sorts of different types. Basically, there's term life insurance. Term is very inexpensive. It's like renting. You can get it for a certain amount of time. So typically, I recommend a 20 or 30-year term policy if you need coverage, because again, it's very inexpensive, especially while you're young. And the benefit gets paid out to your beneficiary in the event of death. And that benefit is also tax free to the surviving beneficiary. There's also what's called permanent life insurance. This is a little bit more complicated. It has some additional benefits, but it's like owning a home. So there's more cost associated, but what you put into it, there's actually some value that you can obtain. So for example, when you buy a house, you put a down payment down, or maybe 100% financing with a physician mortgage. But over time, you're going to build what's called equity, and that's value beyond what you owe on the property. So with life insurance that's permanent, you pay for the death benefit, and the death benefit lasts forever, being permanent. But also you build up cash value, and cash value is an investment component to permanent life insurance that acts like a Roth account where you don't pay taxes as it grows, and you can actually access it tax free. So for clients that have a need for life insurance, they have sufficient cash flow, meaning they have extra savings beyond maximizing retirement accounts or tax benefit accounts. One of the areas we talk about is permanent life insurance and designing it appropriately, or doing like a taxable account and putting money aside where it's invested, no tax benefits, but again, you have access to it. So understand, what's important to you to protect. Shop around for different types of carriers and make sure you're getting what's the best policy for you there. And financial planners should certainly help you out in that direction. So going back to some of the qualitative side, I think, working with a financial planner, a lot of my clients, I'll talk with them a couple times a year. I always say reach out anytime if there's anything that changes in your situation, but you're kind of leaning on them to be your, financial coach, and seeing if it makes sense to do certain things with your money, or if there's things that you're overlooking, or is there additional tax benefits out there that I should be taking advantage of, knowing my situation. But they can help you track progress towards goals, making sure things are all moving in the right direction. Again, if things change, family events, getting married, whatever that looks like, buying, a new home, then we need to adjust the plan. And with the software that I showed you earlier with that net worth statement, the four pillars minus the income, we actually create different types of models to help people see what your finances look like before it even happens. So, I know it might be kind of tough. We're limiting to, think about, my situation is going to change, or I want to do this, but how's that going to impact my cash flow? If I buy a $500,000 home versus a $250,000 home. So you always want to make sure you're making adjustments along the way. I always say too, it's good to celebrate, milestones and things that you accomplished over time, because without getting that sense of reward, it may be tough to look back and say, why did I do this in the first place? So I think it's important to spend some time to reflect there. So in conclusion, and then I'll open up some questions, and then I could sum it up with just a couple other key pieces. But she's understanding her assessment plan, she's getting organized, she's figuring out what her budget looks like, her different employer benefits. Really get some knowledge and information around how best to manage your money, and again, how you want to design it going forward. For different types of professionals, as I mentioned, I'm a financial planner, and there's insurance agents, there's investment professionals. They typically focus on exactly what they do is just insurance only or just investment only. I love the idea, and I'm probably biased, but having a comprehensive approach helps you coordinate and collaborate, for efficiencies from an overall perspective. There's CPAs or tax professionals. They're the ones that are going to help you with your taxes. There's attorneys. They're those individuals that understand the law and contracts. If you're going to look at different types of employers post residency to see, what contract makes sense, because I've looked at them before, and I'm not an attorney by any measure, but there's tail coverage and certain types of compensation metrics and all sorts of different things in those contracts that you sign. So I think it's really important to link up with a physician contract negotiation attorney to help you kind of sift through that and understand what you're actually signing. Mortgage lenders, if you decide to buy a house, they're ones that shop around the marketplace. So look for different financial professionals for your needs. And this just kind of sums it up. It's just a practical example there. So I'll leave this up in the background because I did talk to a few points of this, but any questions or anything you want me to elaborate in a little bit more depth on that we spoke about or haven't spoke about yet?
There are no questions in the chat,
Okay.
but someone
All
said
right.
this is very helpful.
Oh, good, good. Well, that's happy to hear. I know it may be tough to want to open up, with financial stuff. And I totally get it. If anyone wants to contact me or reach out anytime, I'm happy to chat and discuss, your situation with everyone. But yeah, I wanted to go through just kind of a broad overview of things that I find important, for those that are in your shoes and going through an exciting journey. It could definitely be stressful and overwhelming, but again, take it all in stride. Things are going to be just fine for you. Build good habits. Think diligently about what's important. Prioritize goals. And then if you have to, lean on professionals. Others that have been there before, understand the industry. I feel bad through, your curriculum and all the intensive training that you go through with, your college degree, and some even go to graduate school and then go to, medical school and then residency. And I mentioned you're in your late 20s, early 30s, and some of your friends or buddies have started working for years and going out and spending their money or saving to retirement, and you know you're kind of you're a little behind in a sense, but the reward, or the exchange or return of investment for your time and the money that you put to your education turns around drastically. A lot of my clients when they graduate are easily making 250, 300 plus a year, and that's significant income. So it's all going to be all gravy at the end of the tunnel for you. And if you need some motivation or just some additional guidance, please find some financial professional out there or myself to, discuss this with you. I'll leave this up. I'll go to the next page, and then I'll wrap up and open up for questions if there is something that pops up. But your financial plan should incorporate all these different types of things. Anything that's in that kind of green teal, the student loan, disability, life insurance, investment strategy, tax efficient savings. Those are all things that financial planners should be able to help you with and navigate, guide you with your financial plan. Going around this clock here, if you will, the CPA, that's a certified public accountant. Some clients have them. I personally have one as well because my situation is a little different. In private practice, I get 1099 income as an independent contractor, and I have to pay my quarterly taxes, and I have different types of personal retirement accounts. But typically, when you start working, you're going to get what's called a W-2, and that's just a tax form that shows how much earned income you've collected with your employer. It's going to show how much federal tax, state tax, deductions, and all that were taken out. But a CPA will do your taxes for you. That you provide your documentation throughout the year, or you could use like a TurboTax or H&R Block. Property and casualty insurance. I have a really good friend and buddy that works with a company locally. He's independent, but you can find these individuals that will help you with auto insurance, malpractice insurance if necessary, homeowners or renters insurance. That's what property and casualty called PNC insurance. Contract attorney, I spoke about that, and then also spoke about a mortgage specialist. Another thing to write down or keep in your back pocket when you become a resident, you're a physician, and there's some really cool benefits. They've kind of fallen off the table a bit, but there are these physician mortgages where you can borrow, quite a bit of money to put down on a home, and you don't really need to have a whole lot of income to borrow a lot, and they kind of negate the student loans or outstanding debts that you have to obtain a really favorable mortgage. But there's a site called Leverage RX, leveragerx.com. And they have some really cool state specific programs that you can explore for mortgages for a physician. And I'm sure there's other, lending options and things like that. But Leverage RX is a cool site similar to Credible, but more for the physician side. So at the end of the day, my role in service is get people organized, qualitative information, really try to dig into that, educate you, because I think it's important to know what you're getting into and understanding, what's important to you, what your options are from all the different financial components, that we talked about, and then provide guidance. Because sometimes even if you're educated or have the knowledge, then you got to make the decision to move forward and create action. So I think power is more in action than power is in knowledge, because you could have all the knowledge in the world, but if you're not doing anything with it, then you're doing a disservice. So get educated, motivate it, and create good habits, and create your own guidance or find it to build your plan effectively. And here's us at High Point. We have two Brians, Brian Saylor, Brian Benner. These guys actually worked at Vanguard for a number of years, so they have a really unique investment story and approach that I've learned a lot from. This is Jim. Jim's our old partner. We call him Grandpop sometimes. He's a great guy, tons of knowledge. He owned a business prior to becoming a financial advisor. And then here's me on the right-hand side, the young guy, if you will. But anyway, we get along great. We have a really good approach. We tend to work together as a team for certain cases that make sense, and we learn a lot. And we call it cross pollination. We learn different things and strategies from one another. But yeah, we're in Bryn Mawr, Berwyn. I was in Bryn Mawr the other day. Berwyn, right outside of King of Prussia, and we've been in business with High Point for a little over 6 years. So, but yeah, I'll turn it over to you guys for questions, or if you want to reach out, solo, that's totally fine as well. But I'm happy to stick around for a bit.